Hello viewers, welcome back. So this is the 14th video as part of our series Power of Reporting in TallyPrime. So we are looking at the primary report. We saw balance sheet technique, we saw profit and loss account technique, and then we saw in the previous four parts, we saw the stock summary technique. So the next primary report, which is very important and critical, is the ratio analysis. So we'll quickly try and understand the importance and the kind of information that the company can fetch from one single report, which is the ratio analysis. Generally, we call the ratio analysis as the health checkup of the organization's operation or performance. So let us go to Tally and explore the options related to ratio analysis. Let us understand the feature of a ratio analysis. A ratio analysis is basically known as the health checkup of the organizational operation. This report basically provides the information related to principal groups or data points related to principal accounts, and also it provides another critical information, which is the principal ratio. So let us go into ratio analysis and start analyzing the information. Click on ratio analysis. These information are data from your balance sheet and also from your profit and loss account, which you can view them in one single report. So let us start analyzing the principal groups first. So the first one is the working capital. So how do we arrive at the working capital? Incidentally, Tally is given you the formula that is applied to get the information for your principal group wherever there is formula applicable, and also the principal ratio. So the first one, to arrive at the working capital, as we all know, it is the total of current asset minus the current liability. So the total of current asset minus current liability, the company has a working capital of 1 crore 9,54,163.41. Now this is the monies which can be quickly converted into the most liquid form, which is cash. Cash is the physical cash and also money in the bank. So the indication here is that the company has a working capital which can be deployed into the business operation, an amount of 1 crore and plus, which is a healthy environment for this company. The next information that we are seeing here is the cash on hand. So as on date, what is the cash on hand the company has? The next one is the bank account. What is the amount of money that is lying in the company's bank? Now the best part of this report is that any major information of an account we are seeing, we can actually drill down to see the detail of it. For example, it says bank account, there is a bank balance of 14.25 lakhs. So if you want to see the detail, all you have to do is just click on this and you will get the balances. This company has account in two banks and both the bank balances are getting depicted here, and you can further drill down by pressing enter and see the monthly report, select a particular month, and then you can see the voucher transaction. Example, when I select on HDFC Bank and enter, it is going to give the monthly summary of the debit and credit transaction. Select a particular month and press enter. We will go into the vouchers for that particular month. You can just escape, come back. So company does not have any OD account. The next information is the sundry debtors which are to be received, and due till date is the same amount. Similarly, the total sundry creditors to be paid is 1,07,835 and due till today is also 1,07,835. The next information is sales, the total sale for the company as on date, the total purchase for the company as on date. The next one is stock in hand, what is the closing stock that is available, and the net profit amount. The next one is working capital turnover. So what does it mean? The formula, it says sales account divided by working capital. So the total sale is 1.81 crore divided by working capital 109,54,163. So it says that it is 1.66 times. So how do we understand this? Let me put this in a simple example for us to understand. Let us say the sales of the company is 200 rupees and the working capital that is available with the company is 100 rupees. So 200 divided by 100 is 2 times, which means with the amount of working capital of 100 rupees, the company is able to make a turnover twice the working capital amount. That is, they are able to make a sale, collect the money, procure material and sell. So this is an important ratio analysis information which will be useful for the company. In this case, it says with the working capital that is available with the company is able to do the working capital turnover of 1.66 times. So similarly, inventory turnover, again you will see sales account divided by closing stock. So with the available closing stock, that is 72 lakh 5,000. So this is the same explanation that I had given here. So with the available stock of 72 lakh in the company, they are able to sell, collect money, procure and sell, which is 2.52 times of the closing stock that they are able to make the turnover. This side we are basically going to view the principal ratios. The first ratio is current ratio. The current ratio is basically going to give you the ratio of current asset versus the current liability. So we see the value here, 47.65 is the current asset and 1 is the current liability. For every 1 rupee current liability, the company has a current asset worth of 47.65, which is a very good situation for this company. The next one is quick ratio. A quick ratio is basically to find out the composition of current asset minus the stock in hand. So why this quick ratio and why stock in hand is reduced? Because if you see, whatever stock the company is having, they have to find the customer, sell to the customer, provide credit to the customer and then collect money. So it is going to take little longer time for them to liquidate the stock. So if you remove the closing stock here, now for every 1 rupee liability, the company has 16.96 paise as current asset, which is again a good ratio. But if you see, what do we understand from this is the difference here of 47.65 versus 16.96 is an indication that the company is holding larger portion of inventory, which is not a good sign for the company to have large inventory for a longer period of time. The next one is debt equity ratio. This is a critical ratio which the banker is going to look into. If the company is going to go for any loan, the first thing the banker is going to see is the debt equity ratio. Now quickly let me again explain with a simple example. So the formula to arrive at debt equity ratio is loan liability versus capital plus net profit. Supposing if the net profit is not transferred to the capital account, the net profit amount plus the capital account is added together. So it says 0.22 versus 1. So for every 1 rupee capital the company has, they have loan only up to 0.22, which is again a good indication. So the banker would now be willing to give loan because the loan liability is much lesser compared to the capital the company has. So the banker can take a maximum risk of 1:1. The next is quickly for us to understand what is the gross profit percentage the company is earned. So the gross profit for the company is 42.75%. The net profit is 32.04 and the operating cost is 67.96. So if you add up 32.04 plus 67.96, this will come up to 100%. So that means out of 100 rupees sale, the company is able to make a gross profit of 42.75 and the net profit is 32.04, and out of total 100 rupees sale, Their operating cost is 67.96%. The next one is received turnover in days. So it says 43.24. So basically, how Tally calculates this receipt turnover in days is assuming that the company gives credit for various customers on various credit period, and some of the sales they might be doing where they collect the money immediately. So taking into consideration all the sales invoices that has been raised and the amounts that have been pending. See, some customers, even if we extend 30 days credit, probably they might not pay within 30 days. So there might be a overdue delay also in these payments. So Tally takes the average of all the transaction, and it says that if the company is raising an invoice, it takes 43.24 days for it to collect the money. Now this is again a normal situation. Ideally, the receipt turnover in days should be somewhere between 30 to 45 days. Now how does Tally apply this formula? When we select this and enter, it is now going to tell you using the receivable formula, these are the number of average days it takes to collect from each of the party. So we see here Amar Enterprises applying the receivable formula, it takes 28.86 days to collect, but whereas using the actual bill clearance date, it is much larger. So what is this receivable formula? If you select this for Amar Enterprises, the receivable formula is calculated like this: closing balance of the party outstanding divided by total sale into number of days. The number of days here is for the entire year. Now this year is a leap year. You will also see here that the outstanding of Amar Enterprises is 9,31,135 divided by total sale multiplied by the number of days in the year. So this is how the number of days is calculated based on the receivable formula. This way each party's outstanding is calculated, and the average of all this number of days using the receivable formula is what Tally is giving you a single figure, saying that it takes 43.24 days. The next one is return on investment. So what is the return the company is getting on investment? So how do we calculate that? Again, it says the net profit the companies earned during the year divided by capital plus the net profit. And quickly again, the next one, it says a return on working capital. So again, it is the same formula. Take the net profit that is earned during the year, divide by the working capital. The return is now 53.10%. Now here, what are the other simple techniques that we can use? We have already seen that how we can make use of this right side button bar. So one thing that we can look here is that this is the entire year's ratio analysis information that we are seeing. Supposing if you want to view quarterly or monthly breakup of this report, we can do so using the auto column. So click on auto column. So we have this periodicity we understood in our previous sessions. So we can select quarterly, enter, and now Tally is going to break up the ratio analysis information of your principal group and principal ratio quarter wise, which again is going to help the business owners to see their operational performance quarter on quarter. So if you see here, the net profit, it is varying quarter on quarter. Principal group information and your principal ratio is computed for each of the quarter for you to do a comparative analysis. I hope this video would have given you a fair idea of how you can analyze your company's performance through the ratio analysis option or the ratio analysis report. So thank you all once again for staying till the end. See you all in the next session. Thank you very much.